You probably know a little bit about me, but just to give you a quick background, I've been in the mortgage industry for 26 years. I've been doing renovation loans pretty much all that whole time. The last couple years, we haven't done a whole lot just because of COVID. There wasn't a huge need. But as inventory continues to be an issue, it makes it a lot easier if you have maybe a product for something that may not be perfect, but maybe we can make it more perfect for the buyers. So we're going to go through a couple different things here today, but I'm going to start with just looking at some of the numbers that that might motivate you, hopefully, to kind of look at renovation loans as a part of your business, because in 2021, 25% of homeowners spent about $10,000 to $25,000 on home improvements and renovation products, and 70% of those projects exceeded $5,000, and that equated to about $420 billion dollars, excuse me, with a B, $420 billion in 2021 that was spent on home improvements. That's a big market. So. And it's kind of an untapped market because a lot of folks have been kind of avoiding these kind of products because they are a little trickier to get done. But what I don't want you to do is be afraid of renovation products. That's why I wanted to put this seminar on, because a lot of folks feel like they're hard, they take longer, or they're going to explode, things are going to fall apart. But that only really is the case if you have someone who maybe doesn't know how to do them, or if you haven't set them up properly. So what we're going to do today is we're going to talk about the benefits of renovation loans, what different types of renovation loans there are, and then kind of go through how the purchase process would look like for a renovation loan and how that might differ from maybe what you're used to with a normal, just, FHA, conventional, or VA type of financing. So first, let's dive into the benefits. The biggest benefit that I can see is that you can actually go out and market a distressed property, not as a cash, just for cash buyers, but for really any buyer that has a decent credit score and that that may have the desire to go through this process. So what that's going to do is going to increase the number of properties for your buyers, because we all know that inventory has been an issue. So there might be more opportunities for buyers to find a property. It also provides a vehicle, whereas we all know what TLC means in our world. And if there's only 2 pictures on Bright, we kind of know that that means there's some problems on the inside that they may not really want you to see. So this gives first-time buyers or even second-time or third-time buyers the opportunity to take a home that may be dilapidated and make it better. And one of the things it does for you is it creates I think a kudos kind of mentality where you're improving a neighborhood. If you take a property that may be distressed or old or dilapidated and you make it into a newer, better property, the people in that neighborhood are going to love you because you're making their neighborhood better. You're creating value for them, not just for that homeowner, but everyone around them. Because if that home is an eyesore and bringing down the neighborhood, making it better is going to improve that neighborhood for everybody involved. What it also does, it helps you create a vision for your buyers. So a lot of times people go into a house and they say, this house just doesn't fit what we need. And then they go on to the next house. And there may not be a next house in today's market. So this may give you an opportunity to sit down with somebody and say to them, look, this may not be the perfect house for you, but what if we could make it the perfect house for you? And then we start a dialogue around that. And then maybe you can give them some coaching and some ideas on how to make this house their house instead of the distressed property that's there in front of them. Okay. So the next slide, I want to talk about why your borrowers might consider a renovation loan. Again, one of the biggest things is making the home their home. We've done quite a few of these over the years. And the biggest thing that we've seen is people can take a house that maybe is not perfect for them and make it perfect for them. They can get a new kitchen, they can get a new bathroom, they can put new flooring in, they can get new paint, or they can even get a swimming pool on certain programs. So when you're thinking of renovation loans, don't just think of we got to rebuild the house. It might be just making the investment better. It might just be new paint, it might be new carpet, it might be certain things, but we'll get into those details here in a little bit. But it does make a property more equitable, meaning you're going to build equity through sweat equity a lot faster. They can get more money for their home, obviously. So if someone is buying a house that may not be perfect, quote unquote, in terms of size, but they're going to renovate it and then in the future sell it, they're making that house more a better home in the future for resale. And the other big thing that a lot of people don't even think about is it creates financial stability, because many first-time home buyers either don't have the money or they've got to pull money from savings or even retirement at times, where they're taking money out of their own pocket and putting it into their home, where it's very hard to get it back out without doing a home equity loan or a refinance. What we can do is let them keep their money in the bank and finance those improvements instead of taking it out of a resource that they could need down the road, because the economy, the inflation numbers are not looking real positive for the future. So their buying power is going down. So this would give them opportunities in the future to keep their money more liquid. I'm going to touch on just the basic renovation products here, and then I'm going to do a deep dive into each one of those. But to get the conversation started, we have essentially 4 different renovation programs to choose from. 2 are FHA, and then we have a conventional product. We actually have 2 conventional products, but I lump them under one because they're essentially the same. They're very similar. And then we have a VA renovation. So under FHA, there's 2 renovation programs. One is called a limited K, 203K limited, and the other is called a 203K standard or 203K full. The limited K is just for non-structural improvements, and you also have a maximum renovation budget of $35,000. The standard K can be structural or non-structural, meaning you can get foundation fixed. You can essentially build a brand new house on a foundation. You can start from square one if you wanted to. And there's no cap in the renovation budget for the standard K. And the only real stipulation is it has to fit into the FHA maximum loan limits for the county that they're buying in. And in most of the counties around here, it's right around $420,000 right now. That'll probably go up in 2023, but for now it's right around $420,000. Then we also have a VA renovation. Most people don't even know this product exists, but VA has a program where it's only for non-structural renovations, and the renovations must be completed within 90 days. They can do up to 100% financing on that product. And the total renovation has to be below $35,000. For the conventional product, we have either a Fannie Mae or a Freddie Mac product. Not really much difference between the two. The main difference between those and the other products, I'll get into a little bit of that throughout the presentation, but one of the biggest things is that the budget is limited to 75% of the as completed value. That doesn't mean the loan amount is limited to 75%. It means that the repairs can't be more than 75% of the as completed value. And when we say as completed value, we mean that we're going to take the property as it sits, and then we're going to appraise it, assuming that the work that the contractor has given us, the bid they've given us, has been complete, and we're going to appraise it as that work is done. So, and I'm going to get into some benefits of that with the 203K in a moment, but what I'm driving at here for the conventional loan means, what I'm saying is, let's say the subject to value appraises for $100,000. The total renovation budget can't be more than $75,000. However, the loan can be for $95,000, but only $75,000 of that $95,000 can be used for the renovation. If that's confusing to anybody, we can expand on that a little bit later. Now, you guys may already know that the conforming loan limits now have been raised to $715,000. So that's a pretty big number. Around our area, that's usually encompassing most everything. So we don't really have to worry about jumbo. All right, so let's dive in to the 203K limited and compare that to the 203K standard. Both of these programs have to be owner occupied. but you can go up to a 4-unit. As long as they're living in one of the units, we can go up to a 4-unit property. On the limited 203K, there's no minimum, meaning it could be $100, $1,000, $500, whatever. The maximum is for the total renovation costs, including soft costs, is $35,000. Now, soft costs just means inspections, permits, things like that. For the standard K, the minimum is $5,000, and the maximum is really unlimited as long as you're below the FHA limit for the county. Now, for the limited K, it's non-structural only. For the full K, it can be structural. You can actually do a full rebuild if you wanted to. With the limited K, you can't finance any of the payments. But for the full 203K, if the house was uninhabitable, we can finance up to 6 months of their mortgage payment. So while the house is being renovated, they can essentially have no mortgage payment at all through that whole process. That is a big deal, by the way. There's sometimes that creates a lot of tension and a lot of help to buyers because they don't have to worry about a mortgage payment while they're maybe having to rent or live in an alternate place while the house is being renovated. For the limited K, we're allowed to give up to 50% of the contractor's needs for materials up front. Meaning that if they say, let's say they have a $20,000 budget for a renovation, we can give them up to $10,000 to start the work. And then the rest we can be giving them once the work is complete. Under the full K, we won't give them anything up front. We can only pay for work that's complete with the full standard K. Under the limited K, no HUD consultant is required, which is a good thing, by the way. That's one of the biggest stressors we feel with the full K is we have to get a HUD consultant involved to make sure everything is being done to HUD standards, which means they have to come out and do inspections, which creates a little bit more cost and a little bit more red tape to deal with. The borrower on both of these, the borrower is going to give us a bid or a written plan of work will be required, and that's standard across the board. We call it a written plan of work, but really it's just a bid. Under the limited K, they have to have be able to live in the house within 12 months of the loan. All right, so essentially they have 12 months to get the work done. So that's the basic differences between the limited and the full K. Moving on to the VA renovation loan, it's only for 1-unit primary residences. We can go up to 100% of the value. The budget can't be more than $35,000, and again, that includes soft costs. And there's no minimum. Again, it can be $100 or $35. Only non-structural repairs, so no foundation repairs are allowed. And with this one, you only got 90 days, and that can be problematic in this environment where it takes a little bit longer to get contractors out and to get material. So this one sometimes can be a challenge with that. So we got to kind of manage that and monitor that up front. The other stipulation for contractors with VAs, they have to have a VA certificate they have to be registered with the VA and get a valid VA builder's ID. It's not hard to do, but they do have to do it. And we can coach them on that if they need help. The project must be completed by one GC, one general contractor, but they can sub out, right? So we're only going to pay one contractor, but they can sub out to like a roofing guy or a foundation guy if they needed to, okay? With this product, we can give them 50% at closing and then the final draw once it's complete. And I think it kind of goes without saying that for condos, we're only going to allow them to work on the interior because on the exterior, and that goes across the board for any condo, because the interior is all the borrower owns with the condo, right? They don't own the exterior of the building, so they're not allowed to work on that. So we're not going to get involved with that, obviously. So what that means is if they want to get new carpet, new appliances, new bathroom, new kitchen, that's okay with the condo, but anything exterior, that's not going to work. So, and I gave you a list of possible repairs. I'm going to quick run through that. Cosmetic minor repairs, paint, drywall, that kind of stuff. New heating, air conditioning, plumbing even. Wanda, if you were and Marie, we were at the Keller Williams meeting the other day, and they were talking about how expensive septic repairs can be. They can be done here, right? So that's a pretty big deal. If you get into a situation where a septic does fail, this is a way to get that fixed. Okay, with pretty much any one of these rehab or renovation products. You can replace siding, gutters, downspouts, repainting. And if you have someone maybe has a disability, maybe needs a ramp put in, or even a shower that needs to be handicap accessible, that's something that can be done here. Updating kitchens and upgrading larger appliances or something like that. So the VA renovation loan is only for veterans, obviously, but I figure it's worthy to mention that, because if they're not a VA eligible veteran, they can't use this product. Diving into the conventional renovation loans, we can do 1 to 4 unit primary residence. Now the loan to values are restricted depending on how many units, but it has to be for the 4 unit or up to anything more than a single unit, it has to be owner occupied. It can't be an investment. But if it's a 4 unit and it's they're living there, they can actually do a renovation on that. If it's a single unit and the borrower qualifies for one of the first time buyer home possible or home ready loan with Fannie Mae or Freddie Mac, they can get away with a 3% down payment on this product, but it has to be a single unit owner occupied property. So now if someone is wanting to do this for an investment property, this is the only program that will allow us to do renovation, the conventional loan. We'll go up to 85% if it's a single unit investment property. On a refinance, we're capped at 75%. But refinances don't really matter to you, but we do allow for a material draw, which means that if it's a $20,000 project again, and they need $10,000 to buy the drywall, we'll give that to them at settlement. Okay. And then they get paid when the work is done from there. With this product, structural and non-structural repairs are allowed. So if there's a foundation issue, we're all good with that. We just got to make sure that it's being done properly by a structural expert. They can upgrade landscaping and site amenities. It must be permanently fixed to the property, meaning they can't put a shed on. It doesn't mean it has to be attached to the home, but it has to be permanently attached to the real estate, meaning the land. So like, for instance, a detached garage is okay. Even a swimming pool, believe it or not, right? So there's people that sometimes use these products to give themselves some R&R, so to speak. So let's compare the 203K with the conventional loan. So you kind of can see the difference. One big difference on the 203K as it compares to the conventional loan is the 203K loan, the FHA product, will allow an identity of interest sale, meaning a father to son or father to daughter, a relational transaction, whereas a conventional loan will not. They can't be related. That's not allowed in this product. So, but FHA will allow for it. All right. So with the 203K, the minimum down payment is 3.5% of the purchase price. With the conventional loan, for most people, it's going to be 5%. But if they're a first-time buyer and they're under the 80% median income for the county they're buying in, then they can get away with 3%. With a refinance on the FHA, the 203K is 97.75. And with the conventional loan, typically it's 95%. The renovation budget is capped by FHA loan limits. Again, that's about $420,000. With the conventional loan, it is limited to 75% of the subject to value. Again, just meaning that the construction cost can't be more than 75% of whatever the subject to value is. With the 203K and the conventional loan, you can add a swimming pool. You can change appliances on both products, including a washer and dryer. Sometimes people ask about the washer and dryer because that's not a normal thing we see in a home, but they do allow it for the 203K. Now, the big thing with the 203K loan is that you can get up to 110% of the value. So I'm going to go through an example here in a minute, but that is pretty powerful. I want you to remember that because that's critical. The last thing on the conventional loan is it is okay for it to be done on a second home. Obviously, with the restrictions of with a second home, we're capped at 90%, and the investment property, we're capped at 85%. So the 203K loan, one of the things that we run into with these loans sometimes is an appraisal issue where it just doesn't appraise for enough. So that sometimes causes us some trouble. That problem almost entirely goes away with the 203K loan. Because let's say, if we're looking at this example, and let's say the home is valued at, or the purchase price is $250,000, and we're putting $23,000. If you look at this example, we're putting $23,500 in repair budget plus the soft costs. The total cost of this renovation will be $26,600. But the home's only appraised at $250,000. If it were a conventional loan, that would be a problem, because we're only going to lend 95% of the $260,000. But with FHA, we can lend them 110% of this. So we can lend them $275,000 on this project. So they only need to make up $1,600. That's a big deal. On a conventional loan, they would have to make up $26,000. You understand? So this is where this becomes very powerful, because at the end of the day, if the home doesn't appraise, that has happened in this environment. We've all seen it. We're seeing low appraisals because houses are getting bid up. With this type of loan, that all of it goes away, because we can lend them 10% more than it's valued at. Okay. We can talk more about that as we go along, but that's a pretty powerful tool on this. Now, we've already talked about what we can and can't do with these. So I'm not going to reiterate that, but the biggest thing that I've found with the non-structural, like the simple 203K, is people just want to do flooring, like the standard or the limited K. They want to do flooring. They want to maybe update their kitchen a little bit. They want the house to be a little bit more livable. Okay, now if we're doing a full structural model, obviously the same applies. Now, when we're doing a full structural, normally the appraisal becomes less of an issue because we're doing more, right? In this example, we're doing the purchase price is $200, and the renovation value is upwards of $250. In this example, it's $325. So they have instant equity in this situation, which we find more and more because people are improving the home and they're making it better. And in this environment, anytime you do that, people are willing to pay more, right? You're probably seeing it out there in this competitive environment. And we've already talked about revitalizing the area, which is a big deal. I think some areas where we have some maybe distressed homes, this would be a great product to go out there and market, let people know that there's options. Because one of the other things I know is when people's income goes down because inflation has gone up, they're less likely to do improvements to their home with their own money. This might give people an opportunity to get their house up to snuff and not spend their own money. And then they might even want to sell it. It might create a listing for you. Like Marie, we were talking earlier, you're looking for listings. Sometimes people just need to improve their home, and maybe we do a renovation refinance to get their house ready to sell. And then they sell it, and then they can get top dollar for their home. That might be an option for some of these sellers, Marie, that you're trying to find out there. One of the other questions we get is, do I need more money with a renovation loan? Do I need to put more money down? And sometimes you do, because there is some soft costs associated with doing a renovation loan. But for the most part, those soft costs can be rolled in. So the real additional cost to doing a renovation loan is only about maybe $1,000, maybe $1,500 in the greater scheme of things. So I wouldn't worry too much about that kind of stuff. As we go through this process with your borrowers, we can help them understand what the numbers look like. With a conventional loan, typically we need 5% down. So we simply take 5% of the total acquisition cost. So when you're looking at a renovation loan, again, there's two different sets of numbers. We've got to look at the sale price, the contractor bid in this example, and also the reserve and the soft costs. So in this case, the total acquisition costs are right around $230,750. For the 203K, the down payment is only $8,000. plus the closing costs, of course. And then the conventional loan is only 5% down, which is 11,537. Okay. So it's really not that much different than a regular conventional loan. It's slightly more because there's more cost. So it wouldn't be on 175, it's on the total acquisition costs. All right. So that's the one thing we got to kind of contend with. This is a refinance example because it's just a little easier to get the numbers dialed in with a refinance, but on a purchase, it's not that much different. And that's my job. But on a 203K, if the existing mortgage is 175 and it's the conventional loan is comparing them side by side, all else remaining the same, with the 203K, they would have much more room to work with because we can, again, go up to 110% of the value. So with the purchase transaction, again, you're going to have more equity to work with a 203K versus a conventional. With the conventional loan, it's a little more than half. So, but still a pretty good number when you boil it down. The loan process and what's different about a renovation loan as it compares to a regular purchase loan. What we recommend is when we do a pre-approval for somebody, just like anybody you would send to me for pre-approval, I'm going to look at three things. I'm going to look at their income, their assets, and their credit, and I'm going to get them a pre-approval. Now, the difference between the renovation loan, there's a fourth step that needs to be taken very early on, and that is getting a contractor ready to go, because that's a step that's going to take a little bit more time and a little bit more finesse to make sure that it's coordinated properly. Number one, we've got to make sure that contractor, if it's not somebody we've worked with in the past, is approved. We got to make sure that they're good to go. Now, I have a whole team of rehab people to help me and that I work with. They help me make sure that things are moving smoothly. So when I go into a renovation loan, obviously you get me and my team, my 26 years experience, but you also get a whole team of people behind the scenes that are there to help me help you and your client. So, but the biggest difference is that contractor. We want to get them on speed dial, literally up front before they go look at any houses. Because when they go out and look at a house, we're going to need the contractor to go out there and get us a bid pretty quickly so we can stay on course. Now, with these products, we ask for 60 days from start to finish, from contract to close. That way we stay on track and we're not delaying settlement, because there are a lot of things that can delay settlement with these types of loans. So we just want to set expectations up front properly. But if it's done right and we take the proper steps, it's not that much different than a regular loan. And we introduce the renovation team very early on. And if we need a HUD consultant, we help with that. We can make recommendations for contractors, but one of the things I think you want to be careful with for liability reasons is making bad recommendations for contractors. Is just always be sensitive to that. Make sure that if you're recommending somebody, that you're not going to have to worry about somebody coming back and suing you because you recommended somebody that didn't do the job or that went out of business. Yeah, Wanda, do you have a question?
A list of contractors that are approved in certain areas to do that you can pull from?
No, unfortunately, I'm not allowed to give you a contractor list because then HUD is saying I'm steering.
You're steering.
Correct.
Yeah.
So I got to be careful with that. But we can do, but we have people that, I've been doing this for 26 years, just like you've been in the business a while. We have a list of people that we would recommend, but we would always let them make the choice. Okay. I've got a gentleman that I work with regularly. He actually rents an office space from me, who's a contractor. So I know him, I love him. He's great people. So I know he's going to do a good job. I don't have to worry about it. Okay. Right. So we can actually make recommendations like that for sure. Okay. But the process isn't that much different, I guess is what I'm driving at. The biggest thing is the contractor bids so we can get numbers right. And we can't disclose the loan or we can't start the loan until we have that. So that's the step that needs to be taken very quickly. And we hold people to that. We say, look, you got to get this done. And sometimes that creates a little bit of tension, but that's part of the deal. There is a little bit more stress involved with this type of transaction. But if you're willing to take it on, we're willing to take it on with you and your borrower. Yeah, Wanda.
But if you don't have the bids up front, how do you negotiate your contract? How do you put a number on it?
Well, Wanda, that's a good question. And what I recommend is you have a contractor. If you're going to show a house that you know is going to need this, you essentially invite the contractor along. You
Okay.
bring the contractor to the showing, or you
Okay.
have a second showing with the contractor there.
Okay.
Okay. Because if that step isn't done early on, it's a mess and it's a nightmare and it's frustrating for everybody, including the seller.
Right,
Yeah.
because you would literally have to go back and renegotiate the contract once you have your numbers if
correct.
you don't have them up front.
That's correct. And that's very important. So that's why you want to get them involved before you show them a house, right? You want to have that contractor and say, hey, I'm going to need you to be on call so that when we go out looking at houses, and that's not easy. I'm not going to sugarcoat that, but it is doable. So it doesn't mean that they have to be out there for the initial showing, but it has to be within a day or two of that so you can go and make your offer, right?
Right,
And in this
because
market,
more than 2 days, you may be, history that you won't even
correct.
get to put your offer in. I mean,
Correct.
once the market slows a little bit, this is going to be a little easier to tackle, but right
Correct.
now it's not realistic to properties that just hit the market.
Yeah, I don't disagree, Wanda. And for our purposes, there are some homes that are sitting a little longer because of this, right? We're seeing some homes on the market 45 days that because they need work.
Right.
And the buyers are a little bit stressed over that. So, but that's the big step, Wanda. So that's one thing you want to make sure that you really take care of. And if it's a full 203K, we want to get the HUD consultant involved very early on as well. And I'll tell you why here.
Well, and where are those HUD consultants located? I know years ago I did one many, many years ago, and they were in Lancaster to come over to Berks or Lebanon County.
Sometimes that's true. There's fewer and fewer of them, unfortunately, but they're out there, and we have relationships with them, and we obviously can recommend them because they work for HUD, right? So that's a different
Right. So
a different
you can
recommendation.
provide a list of those.
Correct. We can provide a list of those. That's exactly right.
Okay.
Because that's a HUD consultant, right?
Right.
They know
Right.
we're recommending them because of that. So, so the purchase loan process kind of looks like this, Wanda. You're gonna price the home compared to comps, just like you always would. You're going to consider the asking price and the renovation that the borrower is considering, and we're going to try to establish that up front together, right? We're going to try and get an idea of what this is going to look like before it's all said and done. You have the resources to do that better than me, so we're going to work as a team on that. Does it add aesthetic value, or does it give it, does it improve the overall aesthetics of the home, which it doesn't necessarily maybe change the condition, but it may change the value because it does matter how a home looks. Curb appeal matters, we know that. Does it meet minimum property standards? And I'm going to go over a checklist here in a moment that we're going to talk about minimum property standards for this product. So the contractor inspection period, meaning the HUD inspector needs to have enough time to get everything done. All right. So let's talk about minimum property standards. What is important here? Now, different areas of the country have different requirements, but in the Northeast is where we are. There are some things that we're going to look at. The biggest thing that we see here is peeling and chipping paint, or termites, because we're a high risk for termites. But peeling and chipping paint, because of the weather, the seasons, we have to deal with that. So sometimes we do these loans because it's winter, right? And we have issues with weather that makes it impossible for some of the repairs that FHA is requiring to be done. So this is a way where it won't hold up settlement, and we can actually we can put those repairs into the loan and get them done maybe in spring versus winter, right? Mold and mildew. We know that can be a big deal. So, and that can be a big deal to remediate. So that's something that we can do, but we got to do it the right way. Windows that don't open the right way. FHA is very strict about that. They have to open and close, and they have to stay open with FHA, because if they can fall down and a child can get trapped in there, that's a big deal. Missing floor or tiles, that's a big deal. Flooring in disrepair, like carpet that's ripped. Missing handrails, obviously that's a relatively easy repair. We don't normally do those because that's a $100 repair, and usually an hour you can get that done. A roof with less than 2 years of remaining life, that's a big one. What first-time home buyer wouldn't love to have a new roof or a new HVAC system in their home, and they didn't have to write a check for it, but it cost them $10 extra a month or $15 extra a month? that's not a big deal in the greater scheme of things. Most people can afford that. Water stains on walls and ceilings, that's a big deal because then it looks like it could be a problem, right? Meaning if there's water stains, usually there's something causing that. And if there's something causing that, we want to find the root of that problem. Missing bathroom fixtures or cabinet doors, that's a big deal. Dirt, termites, we've already talked a little bit about that. Screens in windows, believe it or not, that's a big deal for FHA. If there's no screens, FHA is going to flag it. Missing doorknobs may seem like a small thing, but it's important. Kitchen fixtures, exposed wiring, knob and tube wiring, right? Maybe you got an old panel box that's been flagged by the appraiser that needs to be repaired, and that's a $2,000 or $3,000 repair that the seller doesn't want to do or just refuses to do. Then the buyer can do that through their loan. Non-operational utilities, we've had that happen where just something isn't working, like a hot water heater quit working, or there's outlets just aren't grounded properly, or something's wrong. There's something that just isn't working. The AC isn't working properly. It's on its last leg. We can do that. And again, well and septic, I think that's a big deal. If we're dealing with a septic issue, that can be a very expensive cost, and you don't know until you get into it. But you can get an estimate, and we do a contingency reserve for that.
I was just in one on Monday where the boiler was like massive rusted out all over the outside of the unit. So
Yeah.
If the outside's that bad, the inside can't be a whole lot better. So I was thinking of this product for a house like that, where you're looking at it that it's going to need a new heating system.
Yep, you're 100% right. And even if that heating system, let's say the home is worth $100,000 and that heating system is going to cost you $10,000 and it only appraises for $100,000, we still have enough room in the 203K limited to do that, because we can go up to 110%. We can lend them $110,000. So we can encompass that furnace in there, and it costs them $40 a month in a higher payment because they're borrowing $10,000 more versus taking an additional $10,000 out of their pocket or getting it from their 401K or something where it's less desirable. Okay. So we already talked about knowing your market, like the Northeast here. Obviously, the biggest things are chipping and peeling paint that we see that people want to repair, or they want to add square footage. Maybe they're buying a house that's too small for their family, or they're updating a home that is too small for their family. Instead of moving, they want to fix their house and stay there. We're seeing that an awful lot right now, actually. So, and home updates, obviously, and roof repairs. We've already talked about those. So the big thing behind these types of products are they're not for everybody. You want to have the right buyer, the right seller, the right contractor, and the right team in place. Because if you don't have the right team, it's going to be a recipe for disaster. And our job is to sort of counsel you on that, to help you get to a point where you're comfortable. And if you're not, then no big deal. We don't have to do these products, but if you're willing to take some of these on, you can help more people get under contract and improve the communities that you're working in. So now what makes us different? Like I said earlier, we have a dedicated renovation team that supports me and helps me. So I'm not in it alone. So if I run into something that I'm just not, I don't understand, I don't know how to handle it, I have a helper to help me do that. I also have a renovation team to help me with my review, so it doesn't take longer. If I feel like I need help with that, they can help me with that. They review the contractor bid day one to make sure we got everything covered. We vet the contractor right up front because we don't want to get stuck with a half-done property. We don't want the borrower to get stuck with a home that the contractor goes bankrupt or bails on us. So that's important. We want to vet them, and that doesn't take that long, but we do check them. We make sure that they have references. We make sure they're legitimate, that they're not going to leave us or your borrower hanging. And outside of that, I'm going to open it up to any questions that you guys have. I am an expert at these. I've done lots and lots of these. I've helped people take their old dilapidated house and make it brand new again. I've helped people buy a home and fill in a swimming pool and get rid of mold. Things that you don't really want in your house, right? We had a client that had a swimming pool it was old and it was dried up and it had like trees growing out of it. and they bought this distressed home, and we helped them get that and make it brand new again. So it's a lot of fun to do that, because I feel like in a small way, we're making the community better and making the, every one of our lives a little better, because when we improve the community, people's attitudes are a little better. We know that. Thank you for being here. You've been a great audience, and hopefully I didn't disappoint. Hopefully you guys were, you got some information here, and hopefully it's going to be helpful to you. And if you have any other questions, obviously we'll get you a copy of the presentation and the recording. And if you have anything you need from me, even if it's just general mortgage questions, I'd love to hear from you, and I'm glad to help.